Hello, everyone. This is Kevin Prince, your host for the weekly show, Market Insights. Thank you again for joining us for this journey. Given the strong response we had towards these sessions, we're going to continue them each week, 1 p.m. on Fridays. Like always, a 30-minute format with some market insights, followed up with some Q&A. Focus for this week is going to be on strategies that combine puts and calls to really generate income and access the market. Now, of course, just like every session like this in the past, you will be getting a survey and a replay. And that's really a great place to ask questions for next week's session so we can take the time and effort to properly respond to each one of them. Now, let me bring in our guests for today. First of all, Patrick Cernezda. He is the TMX educator and host of a popular podcast, Micro Voices, as well as the Market Huddle. Patrick, I listened to your session last week. I really enjoyed those sessions. And where can people actually access those sessions?
Right. So you can find it on just about any podcast player, Spotify or Apple Play or any of them, and just look up Macro Voices or the Market Huddle. And they're also available on YouTube as well.
Perfect. Let me also bring in Mark Rays, who's the head of product for BMO Global Asset Management, as we kick off the journey today. Now, what I want to quickly highlight is, of course, this is really to provide you insights to the overall market. I'm not really giving you advice, neither the guests here either. We're effectively just provide you insights and trying to answer your questions across the market. And with that, let's get started. First of all, this strategy really combines two different parts of a strategy. So it's probably best that we kick in and talk about the first key part of it, the cover call aspect of it. Now, we did talk about this in previous shows, so maybe Patrick, you can walk us through the cover call again, but also give us another insight as an example in that strategy.
For sure. And so what I wanted to really focus on here, and by the way, there are a whole array of really good ETFs that do these strategies within them, and I'm sure Mark will touch upon those a little bit later. But I wanted to just at a higher level, before we talk covered calls again here, I want to just look at it from the bigger picture of harvesting premium with options. And what you're really trying to achieve with it, whether you're covered call writing or selling puts, is you're trying to diversify your returns. The vast majority of investors often over-rely on the need for the market to actually appreciate to make their returns. They need the actual indexes to rise in order for the value of their portfolios to rise. And it's one of the very valuable ways to diversify your portfolio is to create a number of strategies within there, like an asset mix, like its own asset class, strategies that generate very large amounts of income that don't rely on you needing the market for the market to rise in order to make those returns. And so these option overwriting strategies or put selling strategies that are available through ETFs, or you can do them individually, are just one of the great ways of doing that. So if we move to the next slide, what we have here was just talking about covered calls specifically. Now, last week we did cover the Barrick, and I wanted to just use that example again. We'll go a little quicker because most of our the people listening have seen last week's, but let's just go through it. What we're doing is we're actually physically owning shares, and we're selling a call which receives an income premium upfront right away, as real as a dividend. It's in your hand for undertaking a obligation to potentially have to sell that stock into the future at a specific price over a specific period of time. And so if we go to the next slide, we'll actually look at a real example. The other way. One second here. There we go. And so in this example here, what we have is Barrick Gold, in like we did last week, it's trading at $36.60 when I snagged this the other day, and we were selling for just 1 month out to June a $40 call option, and so that basically is an obligation for us to have to sell the stock between now and June, potentially at $40. But the stock's at $36.60. So we have all of the upside appreciation towards $40, but we're limited to 40 because all the upside above we have basically sold away. And for that, we received $1 income. And so that dollar for 100 shares represents $100 income, which is 2.73% in this example, income return in just 1 month. So it's not like most people wait an entire year to earn 2.73% in interest or dividends. Here, in 1 month off of Barrick, we were able to create a 2.73% cash flow and continue to have some participation on the upside further, almost a 10% further capital upside appreciation available to us. So anyway, that's what I wanted to cover as an example. What we're going to get to in a moment is how we can combine that with put selling. So we'll get to there in a second.
Thanks, Patrick. And that's key to lay the foundation, build off from what we've previously talked about here. Now, before we go to the another level of complexity, what I thought I'd do is I'll bring in Mark, because what we can really talk about here, Mark, is how people can maybe access these strategies in the marketplace and different choices out there. So, Mark, maybe you can walk us through why somebody might want to use an ETF to utilize these strategies in the marketplace.
Sure. Thanks, Kevin, and thanks everyone for joining again today. We appreciate it. So certainly you can do individual option strategies. They can be time consuming. There's some effort, operational work involved. It means that, of course, depending on how long your expiries are, you're resetting or revisiting positions. You're looking at how markets move and doing all those types of things on your own. However, within an ETF, you can get a packaged product, a simple buy and hold product that will do the same thing for you. Now, the important thing is to realize that you need to be comfortable with the actual securities that the ETF holds, so the underlying equities. But assuming that you're good with that exposure, whether that's dividends, whether that's banks, other areas of the market, then that option writing is done for you, rolled for you, repositioned for you. And as such, all you do is buy the ETF as a single ticket, just like you would a normal stock. And that call writing is really reset for you over time. So you get the benefits of professional management. The operations are within the ETF. There's some level of tax efficiency because of the capital gains. And you really get what I would call institutional pricing and execution within that ETF as opposed to doing it on your own. So it's just an easier way to go about it for those that aren't looking to do it on their own. Thanks, Kevin.
Thanks, Mark. And actually, building upon that, I mean, before people dive into this space, how do you do some evaluation? What does people look for when different type of strategies out there? And I know you got a slide for that, so I'll advance that slide. But give us some insights people should look for.
Sure. It always starts with the underlying portfolio, as I mentioned. So being comfortable there, whatever that might be, something like Canadian banks, but also realize that the covered call strategies themselves can be implemented differently. So you could write more aggressively and have calls that are closer to the money, or you could write on more of the portfolio, or you could go the other way and write further out of the money on less of the portfolio. And then, of course, how far out are the options? Now, you're not going to be able to really pick that out stock by stock, but the ETF companies will generally have explanation pieces and marketing pieces of how they go about it. What I really like, of course, about the BMO strategy, we tend to start with a good dividend base, and then we write options that are out of the money on only half of the portfolio, which really allows you to participate in the upside of any market movement, like how Patrick was mentioning off the top. So by doing it that way, it's a great implementation. Just realize that can really differ across different ETF companies or fund companies for that matter. And by doing so, that can certainly impact the return. The other thing to keep in mind is, how volatile is the underlying market? Well, right now, when volatility is quite high, and the VIX is up and around the low 30s, that means that you can capture the same amount of premium, but write much further out of the money, which again gives you more opportunity to capture upside when markets are moving. So there is an element of implementation and what I would call a dynamic strategy to cover call writing. Again, you can do it on your own, but if you want the professional management and the ease of use through an ETF, that's a great way to go about it. Thanks, Kevin.
Thanks for that, Mark. And effectively, that's core on the cover call strategy. And what we're going to talk about today is really building on that aspect and really bringing in the second part, which is really the put option. And Patrick, with your background in derivatives, maybe you can walk us through how the put option works specifically. And I know you have an example too, so let me advance towards that.
Or for sure. And earlier in our previous sessions, we were using the put option as protection. We were using it actually like buying insurance to remove risk on the downside. But we can just as easily as investors be the seller of puts as we are buyers. And so it's very important to just look at it from a logistical perspective in the markets. A buyer of a put option pays an insurance premium to have that downside protection. And like an insurance company, the seller receives the premium and earns that premium as income, but has undertaken an obligation. And so I want to focus on the seller of a put option here, because the seller is generating income for undertaking an obligation. Now, the put option has the opposite characteristics of a call, where a call option was the right to buy and therefore an obligation to sell. The put is just the opposite, which is the buyer has the right to sell and the seller of the put option the obligation to buy. And the best way to do this is just to talk about it as an example. So let's move to the next slide, if you don't mind. And so here we are just saying we're going to talk about cash covered puts. And so recognizing that we have an obligation to buy, we have to have cash on the side to actually buy the stock if the stock is put to us. Now, some people utilize margin, and we associate that in the options world with the word naked, where you're naked or leveraged on the exposure. But I wanted to, just for simplicity, say that, well, you sold a put and you had sufficient cash that if the stock was put to you, you could buy it. It's important for us to use that as a foundation. By the way, the one just logistical thing for Canadians, put selling is, while it's available for any investor to do, it's only available in margin accounts. And so if you have an RSP or a TFSA, this act of selling the put option is simply not a choice to be done in that account structure. You have to have that margin account to be able to do it, even if it's cash covered. But the key takeaway here is you're generating income while you're waiting to find out if the stock is put to you. And the real risk is the future stock ownership. But it's at the price you've already agreed upon was a reasonable price. And so let's look at an actual example using Barrick here, the same Barrick we were just talking about earlier with a covered call. But in that previous example, we actually physically own the shares of Barrick. And so in this example, though, let's say we have Barrick trading at $36.60. We really like it. We don't yet own the shares, but we would really like to actually buy it at a cheaper price. Think of it like a limit order, but it doesn't have the same characteristics. I don't want to mix that up, but think of it this way. We're looking at a June $34 put. So we're basically saying that over the next 1 month, over those 36 days that when I made this example, we had an obligation that if Barrick started to decline, we had the obligation to buy it at $34, which is $2.60 cheaper than where it's actually trading today. And for that act, we received $1.15 per share in income. So that's a 3.38% return in a month. Very similar to the covered call example. It's a way of generating a cash flow. But we have an obligation we have to honor. If, let's say, Barrick misses earnings and there's a disappointing drop and it drops to $30, even though the stock's trading at 30, we have an obligation to buy at 34. And so it's you have to just accept that if you can accept owning the shares at $34, it's $1.15 income you're being paid for having sold that insurance and accumulate the stock. And so it's always nice to look at it that if you receive the $1.15, even if the stock is put to you, you got to keep the $1.15. So in fact, your average cost, you can look at it as your break even is actually $32.85. And so if we go to the next slide, the point I want to leave you with is that you can go through an exercise of buying and selling the stock through covered call writing and put selling combined. And this is actually something I did for a chunk of my career working with a portfolio manager, where we were doing this whole exercise, which is, let's say we would turn around, sell a put on Barrick, and Barrick, let's say, would drop, and the stock would be the put would be exercised, and the stock would be delivered to us. We physically now had to buy the shares. And just like a previous example where we were talking covered call writing, we would then turn around with these new purchased shares and begin the exercise of covered call writing on it to earn income. If the stock would rally and we'd be forced to sell, well, we would turn around, let the stock be called away from us, and then we would sell brand new puts to buy it when it dips again. And we would just repeat the exercise, staying market neutral and harvesting income perpetually, flipping from put selling back to covered call writing, back to put selling, and just rinse and repeat over and over again with the objective of harvesting consistent cash flow throughout the whole exercise. There we go. So one more slide. And so really, again, the one last thing I just want to leave with is like, you can basically go through this whole step of utilizing that. If you're one of these obligations was there where you're forced to sell or obligation to buy, you would turn around and just go back and forth between the strategies. And the goal is to create your absolute returns through premium harvesting, through the act of grabbing that dollar income on a consistent basis, rather than depending on the appreciation or market timing of the security, needing to, let's say, that to forecast that it's actually going to go up to make you your returns. I think that's it there, Kev. So back to you.
Oh, great overview. I mean, really what we're getting there effectively is you're going to make income while you're waiting to buy. And then effectively, once you own it, you're making income while you're waiting to sell it. So it's, to your point, kind of that market neutral aspect of way of playing the market. Right. Now, Mark, let me bring you in because effectively, can you give us an overview of the different products kind of follow this kind of strategy in the marketplace? And I know you dealt the slide up already for it, so I'll bring that forward.
Sure. Thanks, Kevin. So for those of you listening that like the strategy, would want to have it as part of their portfolio, but maybe find the operational and the trading aspects of it a little bit daunting, just like a covered call that you can get through an ETF, you can get a premium yield ETF that will follow the same type of strategy. So BMO has one, ticker ZPay. Purpose has a couple, PYF. Dynamic has a mutual fund, so there are different ways that you can get at it. But again, just like covered calls, you're going to have a fair bit of difference in how they implement the strategy. So again, understanding that is quite important. Both for the calls and the puts, time to maturity, distance out of the money, some of the underlying equity portfolio in the book. And by and large, if that yield starts getting outsized, that's telling you that they're being a little more aggressive with the option strategies. But what's really nice about this is you're taking what's a relatively complicated strategy to execute. You're again putting it in a single ticker buy and hold solution. You're getting benefits, lower volatility, increasing yield that Patrick's talked about, tax efficiency. You're not having your own individual trading costs. You're benefiting from the institutional trading within the ETF, and just like Patrick talked about before, lower correlation to whatever else is in your portfolio, whether that's an equity book, bonds, or a balanced portfolio. So it's a great tool to consider adding to your portfolio, and an ETF is a nice, easy way to accomplish that. Thanks.
So, Mark, just to help the investors understand kind of the dynamics, and this really is a dynamic strategy, maybe you can take us for a little deeper dive on ZPay specifically.
Sure, will do, Kevin. So we're starting with, call it 30-40% on average equity exposure. Just like when we talked about covered calls, there's a dynamic element to that can go up or down a little bit. When markets are falling, we'll have more equity weight. When markets are really rising quickly, we'll have less equity weight, and that'll be dictated by the option strategies as well. But of that equity weight, we'll do a covered call on about half of that. That means, again, that other half is fully exposed to the market. When markets are going up, you're going to capture all of that. On the flip side, we're going to have the put strategy, which is going to be backed by cash or T-bills. And there, again, depending on how the market is moving, we're going to have about 50 to 80%, so on average around 60, 70% in the put writing strategy. And what I really like about it is the strategy is quite dynamic in that as markets fall, we're going to end up with more equity positions, like how Patrick was talking about entry points. And as markets rise and we get called away, we'll end up with less equity positions. So it's a really nice way to diversify your portfolio, and it dynamically adjusts to how markets are acting. And if you think about trying to do that on your own, again, it's something you can do, but it's quite complicated. So to do it within a one-ticket ETF solution, to me, is a great way to access the strategy. Thanks.
Thanks, Mark. And we're going to shift gears and move into the question and answers period. I want to thank everybody who took the time and effort to send us a question. Again, at the outcome of the survey for this, feel free to send us questions to get prepared, for us to get prepared for an answer next week. But first and foremost, there certainly has been a dynamic in the marketplace. The Fed itself started buying fixed income ETFs. And the question coming in here, I'm going to use this to go to Mark. Like, you know, with the Fed start buying ETFs, is that going to drive increased demand? Is that going to start driving the price up of these ETFs?
Well, it certainly has, Kevin. If you go back to when this was announced, which was back on March 23, right from that point forward, fixed income, corporate bonds, and equity markets, for that matter, started to march forward because we knew that there was going to be this giant stimulus package coming in, essentially to support markets. So in anticipation of the Fed acting off the announcement, markets started to move quite aggressively. Now, they actually started trading corporate bonds this week. I should mention what the program is for. It's really to support liquidity in the corporate bond market because of the fact they were becoming very illiquid through the month of March. And how are they accomplishing that? They can buy individual bonds, but they can also buy ETFs. How much can they buy? Up to $750 billion. Not saying they're going to spend that much, but when it is about an 8-9 trillion market, essentially that's, you know, they're going to be up there in the 5-10% range. So it's a real driver towards this market. So what they're attempting to do is remove what we call the illiquidity discount. When in March, when people were all trying to sell, you know, they sold off quite aggressively because people were selling whatever they could. So here they're supporting liquidity back in the marketplace. We've already had a significant price move, but even this week when they started trading, we've seen a further advancing in prices by the count of about 2-3%, just to reflect what's currently going on in the market as well. So it's all going to relate back to investor confidence, to realize that the Fed is really backing the corporate bond market. Of course, it's going to be still subject to whatever's going on, you know, with health and COVID-19 and the economy in general. But by and large, this backing by the Fed is really giving price support to the corporate bond market. Thanks.
I appreciate that insight, Mark. Got another question that came in regards towards real return bonds, still staying the fixed income theme. Really what the question is focusing on here is this a viable strategy for somebody that, you know, just really wants to preserve their purchasing power? And then second part of that question really is, what does somebody need to know about these ETFs?
Sure, that's me again, I'm assuming, Kev. So
sorry, Mark. Yeah, absolutely.
Yep. Real return bonds, they do have a level of inflation protection within them. That simply means that the coupon being paid by these bonds adjusts based on CPI, Consumer Price Index, over time. So if inflation starts to rise, the coupons on these bonds pick up, which means the price generally rises because they become more in demand. So we are seeing some interest right now in real return bonds because of the flood of stimulus into the marketplace and the assumption that eventually all this excess money flow will potentially lead to an increase in inflation. What you want to keep in mind is that in Canada, real return bonds are generally long dated. which just simply means, yes, there's an inflation component to the return, but they're also a long bond, and so subject to what's going on the long end of the interest rate curve. Whereas in the U.S., what's called TIPS bonds, which is essentially the U.S. equivalent, they're much shorter dated, where the Canada market is about an average of a 20-year bond, and the U.S. is about an 8 or 9-year bond. So you don't have the same long bond influence that you have in Canada. And depending on what interest rates are doing from time to time in Canada, that element of the return can sort of overwhelm the real return component. Now, if you want to think about other ways you could go about that, something as simple as gold is considered an excellent inflation hedge over time. So there are different ways that you can go about this type of exposure. You know, anytime that you're going after real assets and commodities, gold being the obvious choice, you're getting that level of inflation protection in there as well. So different avenues that you can go. Real return bonds are certainly an option. Just realize at the same time, in Canada, you're dealing with the influence of a long bond as well. Thanks.
Well, Mark, actually, you tipped the hat to the next question because you already talked a little bit about gold. We had a good session last week where we dove into gold specifically. The question really is does actually mention what's BMO's options are in this space, but maybe we can give a quick little refresher of the different types of gold ETFs out there, and then specifically what BMO offers in the marketplace.
Sure. I think the main difference is, are you looking at something that's commodity based like gold bullion, or are you looking at something that is equity based like, gold producers? Different benefits to each. Whenever you're dealing directly with the commodity, obviously that is tied to the price of gold. There are some complexities with the ETFs around storage and, if you're dealing with futures, some rolling, but by and large, you're exposed to the price of gold. When you go to equity producers, now you've also got, of course, some equity market influence as well. So from time to time, if equity markets are doing really well or selling off, you see that influence as well. And we saw that in March when the equity markets came off, that the gold equity companies sold off alongside with it. But we've since seen that those equity producers have really caught up to the appreciation in the price of gold. So depending what type of exposure you're after, there's different ways that you can approach gold. Benefits to both, but understanding the price dynamics between the two of them, I think, is an important place to start. Thanks.
Thanks, Mark. And then another question out there, and maybe I'll lean on Patrick a bit here too. We're certainly seeing negative interest rates being in the news more recently, and what does that really mean for individual investors, Patrick? And then Mark, I'll lean on you for a second about what it means for kind of ETF value too. Start with Patrick.
Well, for sure, and this is such an interesting thing. Like, first of all, go back to like a decade ago, and even just the thought of negative interest rates, you'd be laughed out of a room. And suddenly, we're finding more and more of the world heading toward that. And it's a byproduct or a function of the fact that there's so much debt in our system that they're finding the only way to deal with it is through a form of financial repression. And it's a whole topic in itself how that works. But the reality is that just like how long Japan has been in this state, or even how long it's now been that Europe has been in that kind of a state, it looks like more and more countries are leaning toward it. It's more likely actually that we could even see a scenario of negative interest rates in Canada more than I think in the US, but it is a reality in terms of that coming forward. Now, usually this is done at a government bond level, and it doesn't directly impact an average consumer other than their mortgage rates become a little bit cheaper, gravitating down, often like in Europe, you can see mortgage rates in the 1-2% range, but you certainly are making almost no return on cash balances. And if we keep moving toward that kind of a scenario, investors are going to have to rely on risk assets in order to create returns. You can no longer count on a term deposit earning you enough interest to justify growth in your cash. And so this is where you'll have to turn to alternative interest-bearing things, like doing strategies like we talked about even today, but needing to have equities or real estate or other types of assets to create returns, because you're not going to get very much return from cash.
So then, Mark, give me how it would affect the ETF value, I guess, with negative interest rates.
Yeah, I think the most important thing to realize is when people say negative interest rates, it doesn't necessarily mean all bonds and all types of credit. So if we're talking about, short-term overnight rates, that's not really affecting long-term fixed income as much, although obviously yields would drop, but they'd still be positive. It's more when you get into an extended period where you see, 2-year bonds, 5-year bonds, 10-year bonds go negative, that you'd start to impact other investments like ETFs or mutual funds or just holding bonds. And the other thing to keep in mind is, of course, credit. So when you buy a corporate bond, of course, there's more interest on that bond to compensate you for the risk relative to government. So there's negative rates, and then there's the broader fixed income market. But by and large, what negative rates will do is suppress the yields across the fixed income spectrum, particularly if people anticipate, which looks to be the conversations that are going on, that they're potentially with us for a long period of time. So what does that mean? That does mean if you're looking for returns in your portfolio, you've got to look at other areas like riskier assets, like equities, to really generate those returns in your portfolio. Thanks.
Thanks, Mark. And Patrick, maybe you can help the listeners out here too about where can they find out more information regards towards the option strategy we talked about today, for example.
Right, and so at the Montreal Exchange website, the m-x.ca, there's the education tab, or you can just do /education and get there directly. And when you go there, we have all sorts of amazing resources, and they're all free. And so you can get everything from a paper trading account. Great way to do it is you load up the paper trading account, and actually you can buy a stock and sell a covered call and track it. I often tell people to go in there and buy the same Canadian stocks that they own in their existing portfolios and just buy them in the simulated account, and then add the options to them and see how you do in comparison. You can track and see whether or not it was beneficial, or how much money you could have made or lost. Like a lot of times the learning curve of it's intimidating to do it for the first time, and clicking some buttons in a simulated format is always a great learning tool for giving you the confidence to do it for real. But there's all sorts of PDFs and educational content to educate people on this. So make sure you take advantage. Montreal Exchange spent a lot of money and resources to create this, and it's literally giving it to all of you as a free service. So take advantage of it. Oh, and as well, you could do the options play as well, which is it generates all sorts of option strategy idea for you. You type in the stock, the Canadian stock that you want, and it gives you different option strategies that you can try out. So also take advantage of that completely free. All right, I'm done. Thanks.
Thanks, Patrick. And I'd like to thank Patrick as well as the TMX for taking the time to share their insights and really helping investors make informed decisions over these past number of sessions. It's really been great working with you, and the education, the insights you provide has been on derivatives and the markets has been really helpful, I think, out there. And we're going to shift gears going forward. We're going to bring in the MSCI in the future for the next 2 sessions, but I do think we're going to have both Patrick and the TMX back in the near future. So I look forward to having everybody join us again next week, Friday at 1 o'clock, with our guests, the MSCI, and you probably know the MSCI from the emerging markets, the MSCI EFI fame. We're going to have them talk about not only ESG, but also some of the markets around ESG and some of the research they've been doing around ESG in this space. So look forward to everybody joining us 1 o'clock next week. I'll highlight one more time. Look forward to getting your questions too in the follow-up survey. Have yourself a good weekend. Cheers.